Hey, this is Sasha. Thanks for joining me in today's video. What I want to share with you today is really the problem when it comes to buying single call options and really why it's a bad idea and most people just end up losing a lot of money. So stay tuned. I'm going to share with you some insights and things you need to be aware of when you're getting into trading call options, put options, or just options in general. All right, so a lot of people want to get into options because you don't have to put up a lot of money to trade or invest in the stock. So you could go ahead and do it with options instead of stocks. So that's kind of one big thing that you could do. So here, for example, Disney, if I want to go ahead and get an exposure of about 100 shares in Disney, I could go ahead and let's say I go to the 125. Here, I've got a delta of about 101 here, which is almost 100 shares equivalent to the stock right here, and this costs me $1,020. Now, how much would I have to put up in order to buy the stock? Well, let's buy 100 shares. Let's analyze. There's 100 shares. There is my delta, also 100, which basically means if it goes up $1, how much are you going to make? You're going to make about $100. Okay, so that's what the delta is. That's why I'm saying it's very close and similar as far as a price equivalent goes. So there, with 3 option contracts, I've got a delta of about 100. So again, you can see right now profit and loss -30. So add about 100, so I'd be profitable about 70. So here, add $1, it moves $1 right here. So I'd be up about $80 or so. So anyways, that's what I'm saying is that very equivalent relative to the stock, but this one costs you $1,020. If I did the stock for 100 shares, it costs me $11,702. So that's a big difference. Do I want to pay $11,700 or do I want to go ahead and pay $1,000? So almost 10 times more. And most people would say, hey, I want to pay less. Why wouldn't I want to pay more? Why would I want to pay more? I want to pay less. So a lot of people get into trading options like this and they start out buying a single thing, but what they don't understand, what most people don't get, is there's no gimmies in the market. Is there a lot of gimmies in the real world? No. The same thing here. There's not a lot of freebies in the real world. Same thing here. There's not going to be a freebie. So what happens here is there's a trade-off. What does that mean? That means that you've got to give something up to get something. You're paying less, but why are you paying less? Well, the problem with this is the theta and the time value. When you're a buyer of a single call, okay, in this case we've got 3 of them, we're losing $14 a day. Think of it like, hey, bananas, what happens to them over time? They rot. Think of it like your insurance premium. Well, when you buy it, after 30 days, you got to buy more. Well, the same thing here. We bought an option contract, 30 days, 50 days, 80 days. Eventually, after that expires, I got to buy another one if I want it to, if I want that continued choice for it to move higher, if I want the option for higher prices. With a stock, what's interesting is you don't have that time value problem. There is no theta. There is no time value problem. So I could hold this for years and years and years. I don't have to deal with that. It's a straight line. With an option contract, I've got 2 lines. I've got one line today, which is this white line right here, and I've got one line at expiration. And what happens is with time, I lose this time value right here, okay? As time moves forward, just to show you, as time moves forward, that white line gets closer to the green line. So let's say we start today. Okay, I'm down $21 because of the bid-ask spread, which means, hey, I just got into the position, I'm starting out losing, right? So now what happens is if I move this date, theoretical date forward one day, how much am I going to be down? Well, I'm going to lose $14 to have that option, to have that choice of buying that stock at a higher level. In this case, $14. So add 14 negative, subtract 14 from 23 or 26 now. So it'd be, you're down about $40 or so. So here we go. There you go. You can see $40. Now add another $15. And that time, as you can see, is exponential. It's not going to stay at 14. So we go ahead and now add another 14, now 15, now 15.5. And you can see many days later, you're going to be at 16. So it'll be $16 a day. And then it's going to continue to accelerate, $17, $18, $19, $20 a day. So you'll be losing $20 a day. And if the stock stands still, you lose money. If it goes against you in price, you lose money. If it goes up, Well, it's got to move up. Look at all these strike prices now. It's got to go up 17, 18, 119, 120. It's got to go up all the way just for you to break even now, because you've lost that time premium. You've paid for that time, the choice of having this to pay less money. So that's not the smartest approach to do things, because you're taking money out of your wallet to go ahead and pay for this choice. I think just like with anything, the minute you go ahead and you buy something, there's always that slippage cost, and you got to pay for it. It's kind of like buying here, for example, I want to show you buying anything. The minute you go ahead and buy it, there's that time value associated to it. And in our case here, even if the lawnmower here is very, very new or in good condition, maybe the box is beat up, well, there's a gimme. You're not going to get full price for it anymore. And that's the same thing, is that there's always those gimmes and trade-offs, okay? With option contracts, if you're buying option contracts, you pay less, but you have the time value problem. If you have the stock, you pay more, but you don't have the time value problem. So how do you trade options the smarter way? Well, I definitely recommend you check out the Getting Started page here, Options Trading 101. Definitely go here on our website at tradersfly.com. There's a lot of things here, membership, coaching if you're interested, even courses. If you really want to get into detailed options, I would recommend a course, because you really just get it in all one kind of setting. It's just a lot faster than skimming around for YouTube videos that, you're trying to puzzle piece things together and you hear the same thing. Whereas with a course, you just go one by one and you're kind of done with it. You get some good knowledge. But here, we've got time that works against us. You can see we've got a negative value, negative 14 in this case. If you look at bigger stocks, here is one that's Amazon, a lot more powerful. This one, we've got time value that's negative 97 a day. So that could be a problem, but how do I flip this in my favor? Well, let me flip it to a selling one, and now look, that negative turned into a positive. Now I make $98 a day. So let me show you here as time moves forward. Look at that, 164, right? We're starting at, let's just say, okay, down 100. Let's just add $100 to the next day, right? The next day, time moves forward, I add 100. Look at that. Next day again, $98. I add 100. How does this work? Is it magic? No. It's the same way as insurance companies work. They sell you insurance. They sell you premium. And when they sell you this insurance and premium, it basically gives you time. And that's what's happening here, is the insurance company is selling you premium and time. You as an option trader, you're selling time premium for someone else to have this option contract, to have this choice. And that's what's going on right here, is you're giving them that option contract, you're selling it to them, and you get to collect on time, and you could get out of this anytime you want. So let's say a few days go by, price wiggles around, and you can just go ahead and get out of it early. You don't have to hold it all the way to the end. And that's the way that it works and functions. And this is the smarter way to trade options, is when you're a seller. Think about it. In the real world, do you make money when you're a buyer or a seller? Well, it's when you're a seller. Right? Anytime you buy a stock, are you making money when you buy a stock? No, money comes out of your wallet and you have to purchase something. Then you make money once you've sold it. In our case here, we're selling first and then I buy it back later on, right? Or I conclude the deal and contract. I've fulfilled my obligation of 30-day insurance. I've insured you for 30 days. And just like the insurance company, if you don't get in a car accident, well, they don't have to pay you any money, right? You just send them another 30 days worth of premium, $200 or $500 a month, whatever you're paying, and you just send them $200 every month, $200, and they just keep collecting your money. Eventually, they may have to pay out, but that's what they're managing the risk for. So they manage that other side. Now, in my case, what I want to show you is this is the smarter way to trade options. Here you can see we've got a vertical spread on the left and a vertical on the right. This creates an iron condor spread. And what an iron condor does is it limits your risk on the downside. So you can see I'm limited to about 1505. That's my margin used to potentially make about $500. So percentage-wise, if you take a look at this, if I'm looking to make about 500 on 1505, you're looking to make about 33%. So that's still pretty good. And now you've got a spread and you've got time premium working in your favor. So a stock stands still, you make money. Stock goes up, you can still make money. Stock goes down, you can make money. Up until, of course, your break even. So this is where you've kind of insured really it's at kind of at these peaks, you've insured this stock. And with time, as long as it's in that range, you're good. You're fine. And if it gets outside that range, yes, you do have to pay out. Can you get out of it early? Absolutely. You can dump that insurance to somebody else if you like. So this is the smarter approach to trading kind of spreads and trading options, whereas many other people, what they do is they try and buy singles, betting on direction in this way. But the problem here is time value works against you. So stock stands still, you lose money. Stock goes against you, you lose money. Stock goes up. It's got to go up a lot to offset the time premium. Whereas when you're dealing with kind of spreads and things like this, it's a way better approach. But of course, there's a trade-off. What's the downside to doing a spread versus a single contract? Well, you don't have unlimited amount that you can make. Here, this one, the most I can make is that $495. That's the most that I can make from this because I've already sold it. If you sell, like for example, a lawnmower, let's say I know that my buddy has this lawnmower and I go ahead and sell it on eBay right away, and I can sell it for, let's say, $105. Well, if my buddy will give it to me for $75, then I make money. But what if he says, I can only sell it to you for $120? Well, then I'm going to lose money. And that's the case here, is that you are selling first. And can you sell an item on eBay first without having it? Yeah, absolutely. As long as you got pictures, you list it, you post it, you're fine. But what's your obligation? Your obligation is you got to deliver that item. You've got to ship it. It's got to be delivered, and your contract obligation has to be fulfilled. And that's what happens here in the option contract world, is you've got to fulfill your contract obligation. So if you buy a contract here, you're fine because you've already bought it. You're a buyer, it's a lot easier. But if you're a seller, okay, let's just say we are selling one now, selling a few contracts, as long as it stays above that strike price, I'm fine for those 30 days, 60 days, 90 days. Then my contract has fulfilled. I've held that position for 30 days or 60 days or 90 days or however much time I've sold it for, and the buyer of that was insured. But if you're a seller, as long as that time passes, you're good. You fulfilled your duties, okay? Because then you collect that premium, that time value, as it just sits there, wiggles around, and doesn't do anything. If it does go against you, let's say the stock explodes to the upside, then you've got a problem. And that's why just selling kind of individual ones right here is a little bit problematic. You want to do that with protection. And that's why we go ahead and create things like spreads like this. That's the smarter approach. Anyways, I would highly recommend you check out the tradersfly.com website. There's a lot of getting started for options traders. There's a ton of freebies as well that you could download, which I would recommend you check out. We also have a lot of great courses here. We just released the diagonals one not too long ago, and the butterflies one is coming out very soon. So, and there's some great coaching that you can work with me one-on-one if you're interested, have a lot of questions, you just want some individual attention as well. And you can also check out the membership section there when we look at more intermediate option strategies. So hope you found this helpful, gave you some things to think about and insight on why you want to be very careful and cautious about these single contracts when you're a buyer. Doesn't matter if you're a buyer of a call, doesn't matter if you're a buyer of a put. You still have that time value problem in these kinds of contracts and in these kinds of setups. So even if you're a buyer of a put, you still have that negative theta or negative time. Okay, if I look at the one example I showed you here, we've got positive time working in my favor. So that's what I want you to think about as you continue your educational journey. All right, so thank you so much for joining me. Remember to hit the subscribe button right here if you're brand new. Check out some of those freebies. You can go ahead and download those, get them absolutely free on our website, or of course, continue watching to some other great things on YouTube. Thanks again, and remember to do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you in the next video.